Ever tried buying stocks only to watch your money shrink? I wish I'd known from the start would have saved me so many wrong turns. Our feature today, the most reliable and effective way to invest in stocks. Grace and peace, everyone. Today, we're going to share about the most reliable and effective way to invest in stocks. Note that this title is not about get-rich-quick stock investing. It's about what is reliable and effective. As we've said before, everything connects to faith. Even Jesus himself used the buying and selling in his parables. The man who had received 5 bags of gold went at once and put his money to work and gained 5 bags more. His master replied, "Well done, good and faithful servant." The book of Proverbs also says, "The plans of the diligent lead to profit as surely as haste leads to poverty." We know that God wouldn't illustrate what is right with something that is wrong in itself. The one who received 5 bags of gold and the one who received 2 bags of gold, it's like using the picture of doing business on earth to help us grasp the treasure that lasts forever in heaven. This treasure has true value. Earthly treasure is second best. What lasts forever is the best. And Proverbs also says, "The plans of the diligent lead to profit." This profit refers to abundance in earthly matters. If you want to have all kinds of abundance on earth, you must plan with diligence. Put in more thought. Go the extra mile to plan how to go about. Don't act in haste. It's like buying stocks. You get a feeling. You buy on impulse. The feeling fades. You sell on impulse. It's all done in an instant. That's what it means to act in haste, and surely haste leads to poverty. So we need to reflect on how to use money. It's not just about living within your means. We can also invest because Jesus used that kind of illustration. And investing is essentially buying and selling. You buy, then you sell. A merchant who trades helps goods to circulate, and along the way handles storage, transport, taxes, and so on. These are necessary. Then, you might ask, is running a factory also a form of buying and selling? Essentially, yes. You buy the time and labor of workers, along with raw materials, and then sell the finished product. That too is buying and selling. Today's feature is the most reliable and effective way to invest in stocks, an approach to stock investing that suits most people. Some brothers and sisters have written in hoping to hear more about financial management. Can we talk about financial management in church? Absolutely. Our faith isn't a Sunday-only thing. It's wrong to think we can't talk about this in church. We have to talk about it elsewhere. Everything relates to faith. Rather than discussing it outside the church, let's discuss it right here in the church. Brothers and sisters sharing with one another according to the right principles. That's why this is stock investing suited for most people. Put simply, don't step into pits others have already fallen into. First, we need to understand that stocks can be invested in, but not with a gambling mentality. Gambling means, I think it's going to rise, so I place a bet, and when the moment comes, I sell. How do you know you're buying at the low? How do you know you're selling at the high? Because you want to gamble, you create a lot of risk. Sometimes you win, sometimes you lose, and that brings a lot of trouble. If you have that kind of mindset, you will lose, because the casino has an edge between 2% and 5%. I was once curious about the casino's odds and house advantage, so I wrote a program to simulate it. The simulated results showed that the casino's edge is 2% to 5%. In other words, on average, for every $100 you bet, you lose $2 to $5, or for every 100 rounds you play, the win-loss ratio isn't 50-50. Your loss rate is 2% to 5% higher, so you will lose to the casino. You might win a hand or two, maybe 10 or 20 hands. But after 100 rounds, 1,000, 10,000, a million, you will lose because the house has a built-in mathematical edge. So I ran the program a million times. 10 million times. Such simulations aren't difficult, and I found that the casino always wins in the end. The key is the house edge. For example, the way bets are laid out, the odds on big versus small, the payout ratios on different numbers, they're all carefully designed. You may think you can win, you may trust your luck, but statistically, you will lose. Doesn't that sound a lot like the stock market? Of course, the stock market is legal, and its edge isn't that high. Each trade charges a commission of about 0.15%. A round-trip buy and sell costs 0.3%. It doesn't seem like much, but whenever there's a bit of news or market noise, you jump in and out. So if you want to invest in stocks, the first thing to know is reduce the number of trades. The more you trade, the more you lose. Over the long run, that adds up to a significant amount. Let's first understand what the stock market was originally meant for. The stock market is a market for stocks, the equity of a company that can be bought and sold. For example, if you become a 10% owner of a company, you're entitled to 10% of its dividends, much like being a landlord who collects rent. When the company makes a profit, you receive a share of that profit as dividends or distributions. It's the same idea. Of course, for a publicly traded company, owning 10% is nearly impossible. If you reach 10%, you're like a major institutional investor or foreign fund, a true big player. Even a tiny fraction, say a millionth of the company, can still generate meaningful income. We need to remember two key statements. They're very important. Measure a stock's price by its dividend. Whether a company is profitable or not, favorable news is bullish. Unfavorable news is bearish. So what does that have to do with you? If the company doesn't pay you a dividend, all of that is essentially meaningless. Haven't you noticed? We have to stay grounded in reality. Measure a stock's price by its dividend. As a shareholder, how much dividend can you actually receive? That is the most fundamental essence. And measure a property's price by its rent, whether you live in it yourself or someone else does. If someone else lives there, you collect rent. If you live there yourself, you save the rent you would have paid. If no one wants to live there, the property is meaningless. These two statements are extremely important. I encourage you to say them aloud 10 times. Here we'll say them twice together. Measure a stock's price by its dividend. Measure a property's price by its rent. Measure a stock's price by its dividend. Measure a property's price by its rent. Today, we're focusing mainly on stocks, so we look at dividends. Higher dividends mean higher returns. As for a rising stock price, that's capital appreciation. This stock, this company, is especially profitable. So when it was first issued at, say, $10, I'm willing to buy it at $11 because its returns are high. You might be willing to pay $12, $13, $14, and eventually it rises to $100, $200. That's what we call capital appreciation. Real estate is also a form of capital. Because many people want to rent it, and rents keep rising, the property price goes up. I hope everyone truly grasps this essential nature. So, the meaning of a rising stock price is capital appreciation. You can earn returns, and you can earn capital appreciation. But capital appreciation still comes from returns, that is, paying dividends. A company may have all kinds of good news, a bright future, and great prospects. But if it doesn't make a profit, it's meaningless. And even if it makes a profit, but doesn't distribute it to shareholders, then for you as a shareholder who bought the stock, that is also meaningless. So we need to understand its original purpose, its essence. That essence is the dividend, the return. What's absurd about today's stock market is that the original intent of a stock was to receive dividends, yet now everyone is chasing the stock price. That's like a game of hot potato or a pyramid scheme passed from one person to the next. Whoever is left holding it when the music stops, crashes, and loses, That's why we must see its true nature clearly. So, how can you invest with better odds? There are two approaches. First, from a technical perspective, on the right we see its K-line chart. Some of you know it, some don't. That's fine. We'll go through it together. What we call technical analysis-based investing means using historical data to predict future price movements. This data is what's used for technical analysis. Examples include K-lines, moving averages, MA, the relative strength index, RSI, the moving average convergence, divergence, Bollinger Bands, R-bands, and many more. From what I know, there are already dozens and even hundreds more. Yet all these dazzling technical indicators are essentially historical data, things that have already happened. You can trade based on human judgment using them. For example, the middle line you see on the right is the moving average. The upper and lower lines are Bollinger Bands combined with the K-line. By observing the trend along with the Bollinger Bands and moving average indicators, you can roughly predict its direction. Have you ever considered using computers to make the judgments, that is, programmatic automated trading, or what's called quantitative trading? For example, there's a platform called MT5, MetaTrader 5. I think it's up to the 6th generation now. Once a brother, quite a sincere guy, was discussing these investments with me. He'd studied for half a year and couldn't make head or tail of it. I said, "Give me the data. I can probably figure it out in a week." Actually, when programmers write code, the problems are often much more complex than this. So in about a week, I'd mostly grasped it and wrote a program along those lines. I tested it against historical records and found that it actually seemed to work. But here's the thing again. Arguments without a clear stance are pointless. We have to stay grounded in reality. Let's try to avoid saying this could work, that could work. Let's state the conclusion directly. You may think it's effective, but it's historical data. In real-time trading, the patterns keep changing. The rules you derive for the program to follow are based on the past, but the actual trading happening right now is constantly shifting. It's very hard to pin down. The key is, when you trade frequently, just like with the casino earlier, you're constantly paying transaction fees. So overall, this approach loses money. It's very hard to make a profit. I think God really loves me. He let the programs I wrote look correct on paper. But when it came to executing them, they just wouldn't run automatically. I once asked an expert in this field to look at my code. He said, "There's nothing wrong with your programs, but the moment you try to run them, they simply won't automate." When that happened, I knew it was God stopping me. It's enough just to understand this. Don't pour yourself into it. When you trade frequently in the short term, whether manually or with automated programs, first, it takes a lot of time and it affects your emotions. In the long run, the win rate is relatively low. I won't deny that there are trading experts or highly effective automated trading programs out there. In fact, I've written a few myself that I felt quite confident about. But in the end, I put them aside and stayed at the stage of just knowing it's possible. What we're discussing today is an investment method suitable for most people. So the first thing is to rule out technical-based investing. These indicators are only for reference. Don't invest just because you see them. You can ask around, are the people who trade this way actually making money or losing it? I'd venture that most are losing, because I've already run computer simulations tens of thousands, millions, even tens of millions of times. For the average person, this approach is highly unfavorable. Generally speaking, humans can't outperform computers. But does that mean computers always win? Not necessarily. There's a reason. As I mentioned, I spent a week studying automated trading, letting the program decide trades for me and backtesting it against history. That sounds pretty reasonable, right? Shouldn't I just be able to sit back and make money? Honestly, that's what I thought too. Look at the chart on the right. When certain indicators appear, it seems like a relative low to buy. When other indicators show up, it seems like a relative high to sell. It looks correct on the surface, but there's a hidden catch we need to watch for. So, do you think you can just sit back and profit? The answer is no. Why? Because you're using a program, and so is everyone else. Once everyone spots the pattern, they react ahead of time, and then the pattern stops working. The chart on the right uses moving averages, MACD, the relative strength index, a combination of indicators. It looks very regular, doesn't it? But if you notice the pattern, others have noticed it too. So when everyone sees it, they act in advance. I know that when this indicator is triggered, I should buy. So I'll buy before you do. He thinks the same way, so the buy point keeps moving earlier. The same goes for selling. The sell point keeps moving earlier. And sometimes, the market is swayed by major players. Retail investors are those with smaller capital. Most people are retail. Major players include institutions, foreign funds, even the company itself buying back its own shares. Their capital is enormous. You might think $1 million is a lot. Others are investing billions. In short, you're retail. Retail investors try to catch the pattern, but the pattern is created by the major players. And those major players can sometimes manipulate the stock to form what looks like a signal, so retail investors chase it. I hope you see what I mean. When that pattern stops working, a new pattern emerges and the cycle continues. In the end, from a technical standpoint, this kind of investing is meaningless. So we can sum up 2 points. The human brain can't beat the computer. That is right. A person might trade 10,000 times in a lifetime, but a computer can trade 1,000,000 times in 1 second. By the time you've made your 10,000 trades, you're old. The computer is better. That's a fact. Then why doesn't the computer make money? Because the computer can't outsmart human nature, the nature of retail investors, the nature of major players, the nature of everyone. Sometimes you think you're right, but you don't stick with it. Sometimes you stubbornly believe you're right and end up wrong. So you're stuck in this cycle, and it's agonizing. The conclusion is retail investors drop this trading approach. So how can you invest with better odds? Use the second method, fundamental analysis. Fundamental analysis means going back to the true nature of a stock. What kind of company is this stock? What does it do? Does it have an advantage? Patents? How's its revenue? Are its profits solid? That is the true nature of a stock. And before that, let's return to the true nature of money. The true nature of money is 4% annual inflation. We mentioned that earlier. So each year, 4% inflation affects stock prices. Houses are bought with money. Stocks are bought with money. Money is visible. What's invisible is human nature. So, let's define the conclusion a little more clearly. For most retail investors, the goal should be set at an annual return of 5 to 8%. Don't get carried away just because you profit once. Don't let it go to your head, because the next trap might appear in a way you don't expect and you'll end up losing even more. Let's look at this example. You might think, I want to buy here and sell here. In reality, you can't do it. When it drops to this point, you get scared. When it recovers and you finally decide to buy, you might end up buying right here because you don't know what comes next. Then you think, this is a golden cross. It's about to surge, and instead, it gives you a sharp drop. While you're hesitating, it goes up and down, up and down. It drops to this point. You say, look at the previous low, but it actually falls even lower. You might end up cutting your losses right here. After you've sold at a loss, unexpectedly, after falling a bit more, it comes back up and rises like this. Then you can't stand it, so you buy it back again. Then it reaches the previous high, and you say, I should sell now. This time your judgment is correct. So you sell, and you think, I sold at the high because comparing it to the earlier move, it seems to have reference value, right? All right, suppose you did make a little profit. Then it drops back to the previous low. You think, this must be the bottom, so you buy again. It rises to this point, and you're thrilled. This time, you're going to make a big profit, right? Sorry, no. It plunges straight down, falling to here, and wipes out all the gains you had before. I hope you see what I'm saying. Technical investing isn't suitable for retail investors. It's not suitable for the vast majority of people. What you think you've gained, one day you'll have to give back. That's why we say, for most retail investors, the goal should simply be set at an annual return of 5 to 8%. Bank interest rates are around 2 to 3%. Inflation is 4%. So we aim for a return higher than inflation, 5 to 8%. Don't think that's low. Actually, that's already considered high. Think back, over the years, as you've been tossed up and down in the stock market, have you really come out ahead? You know how moms always say, don't go where the crowd is. The so-called stock chatting aunties at the market and retirees all gather and talk there. Don't go where the crowd is. You can just ask them, are they making money or losing it? Most are losing because they want to make 50%, double, triple their money. And in the end, they lose even more. So don't underestimate 5 to 8% over the long term. It's remarkable because that's compound interest. Compound interest means interest earning interest, and it's powerful. Einstein is said to have remarked, the most powerful force in the universe is compound interest. That compound interest is the eighth wonder of the world. Those who understand it earn from it. Those who don't pay for it. We certainly want to earn from it, not pay the price. As we said earlier, the plans of the diligent lead to profit. We are to be diligent in planning, not in haste, as surely as haste leads to poverty. Next, I'll use Excel to do a compound interest demonstration. Everyone will see it clearly. A picture tells the story. Let's look. This is year 1. This is year 10. This is year 20. This is year 30. If you recall, at 4% in year 0, you have $100, or 1 million, or 10 billion. It doesn't matter. We'll just use 100 to represent it. So year 1 is 104. Let's see the difference starting in year 2. Year 2 is 108. Year 3 is 112, and it continues. By year 10, note that it's 148, about 1.5 times. By year 20, it's doubled, over 200. By year 30, it's tripled, over 300. So we reach a conclusion. At an interest rate of 4%, the amount doubles in 20 years and triples in 30 years. What happens at 8%? Remember, inflation is 4%. We want to beat it. Let's look at what 8% does. Year 1, 108. Year 2, 117. By year 10, it's already doubled, 216. In other words, if you can find an investment that yields 8% annually, by the 10th year, your money will have doubled. Then by year 15, it's tripled. Notice, doubled in 10 years, tripled in 15. By year 20, it's incredible, 4 to 4.5 times. By year 30, it's already 10 times the original amount. And that's just at 8%. Do you see how powerful that is? The appreciation of real estate is tied to inflation, at least 4%. If you're not investing in real estate, or if you also want to invest in stocks, you should set a target of at least 5 to 8% for it to be meaningful. Don't think that's small. In reality, its power is tremendous. So we arrive at the conclusion. At 4% compound interest, the amount doubles in 20 years and tripled in 30 years. At 8% compound interest, it doubles in 10 years and triples in 15 years. Compound interest means reinvesting the earning interest on your interest. That's compound interest. Compound interest plus time is extremely powerful. The goal for most retail investors should simply be set at an annual return of 5 to 8%. The key is to outpace inflation and beat the bank's interest rate. Let's look at a passage of scripture. A faithful person will be richly blessed, but one eager to get rich will not go unpunished. I need to add a clarification. For most people, don't be eager to get rich overnight from stocks, because one eager to get rich will not go unpunished. The key is simply to outpace inflation and beat the bank's interest rate. Let's continue. How can you invest with better odds? It's about fundamental analysis. Pay close attention to the following indicators. I'll keep it as simple as I can. If you don't understand it at first, don't rush to buy. Listen all the way through. You need to grasp the key points. We say conversation should have substance. Well, a video should have key takeaways. These key points, you need to learn them. First, you need to know something called the dividend yield, often just called yield. It refers to the income an investment earns, usually paid in the form of interest or dividends. Simply put, it's the return. If you buy $10,000 worth of a stock and that stock pays you $1,000 in dividends each year, then your yield is 10%. Simple math, but extremely important. There are actually many stocks with yields over 5%. We can look for them carefully. This is the first key indicator. You can even find stocks with yields above 10%. Extending the earlier example, you buy $100,000 worth of a stock and it pays you $8,000 in dividends each year. Your yield is then 8%. That means you earn 8% a year. That's already considered very high. The second indicator you need to know is the price-to-earnings ratio, PE. The PE ratio means share price divided by earnings per share. It's a measure of whether a stock is priced high or low relative to its earnings. For example, if a company's total market value is $1 billion and its annual profit is $20 million, the PE ratio is 50. In the context of Taiwan, you can generally consider a PE ratio around 30 as a reference point, because a higher ratio tends to be less favorable. The example here with a PE of 50 suggests that the stock price is on the high side. But didn't we just say yield is extremely important? Why look at the PE ratio? Because if the PE ratio is too high, the price you pay is high and your yield will be low. Say you buy $100,000 of stock, get $8,000 in dividends, yield is 8%. If the stock price rises to $200,000 before you buy, then you're paying $200,000 for the same $8,000 in dividends, and your yield drops to 4%. I hope that makes sense. So the PE ratio indicates a company's earning power. With $1 billion in assets earning $20 million, the PE is 50. With $1 billion in assets earning $100 million, the PE is 10. A PE of 10 is better. In addition, there are earnings per share, EPS, and return on equity, ROE. You can look these up for reference. In fact, these numbers are readily available in public reports. You don't need to calculate them yourself. Just look them up. Here, we're trying to keep the explanation as simple as possible. The third major area is financial health. The dividend payout ratio, PR. Is a high payout ratio always a good thing? Not necessarily. If all the profit is paid out to shareholders, that's good for shareholders in the short term. They get an immediate return. But for the company's long-term operation, it depends. How much of the profit is paid out as dividends? That's the dividend payout ratio. Then there's free cash flow, FCF. If a company has no free cash flow, and cash is like blood, that company can easily die. This relates to its financial health. Even if it's profitable, if it has no cash, it still faces serious problems. Next is the debt to equity ratio, DER. This isn't mentioned as often, but it's actually very important. If your debt to equity ratio is too high, you face pressure to repay because borrowed money must be paid back. Even if the company appears profitable and pays high dividends, we need to be cautious in such cases. So the third major area refers to financial health. The fourth area covers any other factors, future prospects, company history, institutional holdings, news, and so on. These are all worth considering. We're trying to keep it simple and put the most important indicators first. That is, look at the yield, then the PE ratio, then check the financial health. After that, you can decide whether to buy it. When you buy it, you should plan to hold it for the long term, say more than a year. Remember, we're not after getting rich overnight. We're after what is reliable and effective. Then there's another question. Should we invest in individual stocks or buy funds? Funds have fund managers, right? Wouldn't their judgment be better? Let me tell an old Wall Street joke. On Wall Street, there's a saying, people who drive Rolls Royces go to people who ride the subway for stock tips. This isn't meant to praise or put down anyone, but in terms of earning power, it's worth thinking about. Sometimes so-called fund managers don't necessarily make better judgments, and you're paying them for it. The cost of trading stocks is about 0.003 or 0.3%. The cost of a fund, however, is typically 1 to 2%. The ETFs, index funds, regional, country, sector funds, and so on that we often hear about, all of these are funds. They carry some hidden costs. If you'd rather not think it through, you can hand it over to a fund manager. But be aware, they're taking a cut of your money. So even if you decide to invest in funds, first, your costs are higher and you still have to make a choice. Which ETF, which index fund, which sector, you still have to choose, right? If you invest in stocks, you do your own homework. That's better. That's my recommendation. Because the plans of the diligent lead to profit. You do your own homework. You figure it out yourself, and you plan diligently. If you act hastily, make snap decisions, or leave the decisions to someone else, you'll end up paying a price and likely come up short. So spending some time to plan is worth it. Next, let's look at an example. Is a stock from a good company always worth buying? Let's examine this stock. As of the 25th, its price is $343.25. That's very high. Some of you may have already spotted it. What did we just learn to look at first? The yield. The yield is 0.82%. Is that high? Actually, it's not. It's even lower than what you'd get keeping your money in the bank. But if we look at its PE ratio, it's only 28.5. This is a highly profitable company. Some of you may have guessed it already. It's TSMC, Taiwan Semiconductor Manufacturing Company, a company that's in the spotlight worldwide. It's an excellent company, but is it suitable for you to invest in? First, its PE ratio is favorable. Is there still room for capital appreciation in the future? Very likely. But from the perspective of investing based on yield, it's on the low side. Its dividend payout isn't high. Then you might ask, if that's the case, why would anyone buy it? We need to understand that these major players, institutions, foreign funds, large shareholders, buy a company's stock not necessarily to earn its yield, but to exert strategic influence. Recently, there's been a lot of buzz about TSMC building plants in the US, a real uproar. As the saying goes, outsiders watch the show, insiders know how it's done. Although TSMC is run by Taiwanese, foreign investors hold a larger share of its stock. The combined holdings of the government, retail investors, and domestic institutions account for less than 30%. The rest is held by US and the global foreign capital. The technology resides in the hands of countries like the US, Japan, and the Netherlands. Add to that the fact that the US is a major shareholder, and combine it with the thinking behind global supply chains. This is actually quite normal. I hope everyone doesn't just follow the crowd. TSMC's expansion across Taiwan is already on a very tight schedule. In terms of the global supply chain, this is fairly standard. So after all that, is this stock worth investing in? From a PE ratio perspective, there's still room. From a yield perspective, for most retail investors, it's not a great fit because its return is too low, even lower than a bank time deposit. If you want to invest in it, you're basically playing with your nerves. We don't encourage that kind of investing. So investing can also be seen as a 3-level building plus a basement. The basement and first level are the physical, material, and money. The second level is the man and mind, emotions, and will. The third level is faith, God, eternity, and love. Our Lord Jesus uses earthly investments, money, material things, tangible assets to help us understand heavenly investment. Fine Foods, 7 minutes, quick reminder. On the 7th, 17th, and 27th of each month, we have a feature topic. There is no regular reading schedule. The day is for rest or for catching up. For today's related topic, please watch the March 7th feature, What You Should Know About Real Estate. If you haven't seen it yet, remember to catch up. Conclusion: the most reliable and effective way to invest in stocks. Take the 2 bags or 5 bags of gold that Jesus gave and put it to work, whether in earthly matters or in heavenly ones. Don't buy stocks with a gambling mentality. You will definitely lose to the casino. Must see the true nature clearly. Measure a stock's price by its dividend. Measure a property's price by its rent. First type of investment: technical-based investing. Patterns eventually stop working until new patterns emerge. If you trade stocks frequently, it wastes time, affects your mood, and has a low long-term win rate. Most people should not do this. The second type is fundamental investing. Aim for an annual return of 5 to 8%. That's enough, because compound interest plus time is powerful. We're not relying on it to get rich overnight. We want what is reliable and effective, enough to outpace inflation and beat the bank's interest rate. Look at the key indicators. Main points are dividend yield, its return, PE ratio, profitability, financial health of the company, and other factors. These indicators are already quite few. If you're serious about investing, remember to look into it. Spend some time doing your homework. It's actually not that hard. If you buy a fund, you'll pay fees, and the outcome isn't necessarily better. These are all things we can learn. Let's close today with this verse. The plans of the diligent lead to profit, as surely as haste leads to poverty. Blessed is the one whose delight is in the law of the Lord, and who meditates on his law day and night. Fine Food 7 minutes. See you tomorrow.